Today I will break down JD Wetherspoon, explain why shares haven't recovered from its all-time high in 2019, and reveal whether it is a great investment opportunity or a sinking ship that we need to avoid. In the last 5 years, JD Wetherspoon has seen its revenue increase by 6% to £1.9 billion. JDW has had an impressive recovery from the pandemic low in 2021 of £773 million, albeit profits are 18% below 2019 figures, and this is also shown in the mediocre return on capital employed of 10%. Although in the hospitality industry, it would probably be unrealistic to expect much more than what they have. It appears that free cash flow has seen a remarkable increase of 156% since 2019. However, the free cash flow figures are deceptive, and I believe that it is not as good as it seems. In order to explain why I believe this to be quite bad, we need to take a look at the balance sheet to find out more. We can see that JDW has seen its debt increase by 34% in the last 5 years. However, notably, the number has decreased by 25% since its peak in 2020. Which brings me to the obvious question. If JDW was operationally impacted in the pandemic, how did debt reduce whilst unprofitable? By looking at the earnings per share of JDW, we can see that it's fallen by 35%, and this is greater than the 5-year change in the reported earnings of minus 18%. We can therefore infer that shares were diluted. A share placing was required to raise capital during the pandemic, which we can see by both the increase in the total shares by 24% in the last 5 years and the increase of cash in 2020, which was clearly used to pay down the debt in 2021. But wait, this does not explain why the reported free cash flow figures are not as good as they seem. In the 2023 annual report, they mention the use of interest rate swaps to generate an influx of cash flow. This gets complicated quick. In this instance, the company exchanged its lower fixed interest rate debt into a variable rate loan and received a cash payment for this transaction. I believe that they then locked in another fixed amount for the rest of the debt as rates increased. Sounds good, right? Well, they've managed to reinvest this cash back into the business and significantly improve the quality of their balance sheet by the use of freehold reversions, aka buying a pub that Wetherspoons was previously the tenant of. The problem lies in the current weighted interest rate, which of this debt is now 4.28%, which compared to 2022, it was 1.61%. When we also look at the duration of the debt, it's also reduced to 2.9 years from the longer term debt of 6.4 years in 2022. Now, I find this concerning as a long-term investor, as it suggests that the management had prioritised the short term, and by reducing that debt they seek to appease shareholders to make the company appear like it was in a better financial position. But in reality, if they'd have just held on to this debt for a longer period of time, inflation would have eroded at that debt figure and they would have had a far greater quality balance sheet over time. Perhaps it's unfair for me to say this, because in hindsight it's obvious that they have survived, and in this moment perhaps cash flow was obviously of a concern, and it's likely why investors have remained bearish on JDW stock. When we look at the net position on the balance sheet, it has worsened from minus £520 million to negative £690 million in the last 5 years, which is a big red flag for value investors seeking book value. A continual fall in this net position will likely drag on the share price. Therefore, if I were to be a value investor, it is imperative that I identify a very attractive price in order to manage risk. To do so, I'm going to start by looking at relative valuations. Currently, JDW is trading at 13.8 times 2023 earnings, which is closer to that of its 52-week high and greater than the UK market average of 11.3 times. Historically, the price to earnings ratio has been volatile, leaving an average 5-year PE of 11 times. This is suggesting that JDW shares are slightly overvalued. That said, a price to sales ratio of 0.4 times paints a different picture, in which JDW is cheaper than the UK market average of 1 times. JDW also appears to be half of its historical average at around 0.9 times. The price to book ratio also shows a similar picture, in that the 2.1 times ratio is considerably lower than the historical 5-year average of 3.6 times, which this could be good for value investors that are seeking mean reversion. But wait, didn't I say that this is not a good investment for value investors due to its falling book value? Well, yes, I did. However, there's more than meets the eye with this investment, and it could be the difference between making significant chunks of money or losing it all. Wetherspoon has a large property portfolio. They have over 800 pubs, of which 70% are freeholds. JDW states its value to be approximately £1.38 billion in 2023, and that, most importantly, the properties have not been revalued since 1999. We can infer that the property portfolio is understated and that there's likely underlying value based on this. So whilst the balance sheet appears to be unattractive with that debt to equity ratio of nearly 300% and very low current and quick ratios, the property portfolio could present a big investment opportunity for those seeking value investments. But I do think those potential investors should ask themselves if investing in hospitality is really a good place to park their money. Dividend investors should certainly look away as they cut and suspended their dividend during the pandemic in 2020. Not that JDW was really known for its dividend growth at all. I personally think that the industry isn't profitable enough and that competition is fierce. It's hard to create a differentiating product or service in the niche as most pubs stock the same drinks and have a similar atmosphere. That said, there is room for disruption, and we have seen this previously, and that we're seeing a lot of hospitality venues that are hosting activities alongside the sale of alcohol. Based on a discounted cash flow valuation, I think a fair value for shares of JD Wetherspoon is around £7 each, but I'd want a greater margin of safety on price, and this is because of the falling book value. You should know that I have some bias to JD Wetherspoon. I do hold 1,000 shares as part of an employee share scheme. It's also key that you're aware of value traps, as it can cost you as an investor serious money. If you'd like to know if Lloyd's is a value trap, then click here.